Hi, Jay Roberts here, founder and CEO of Prosper Group. We're at the Real Deal Forum 2025 with Kevin Maloney, the founder and CEO of Property Markets Group, PMG. Kevin just finished the Who's Got the Hottest Condo project panel. It was great. There was a big event that just happened yesterday in New York, and we heard that you voted for the person who won. How do you think the New York City mayor election is going to impact Florida real estate? Do you think a lot of people leave from New York?
I do. So I couldn't vote for him actually because I'm a Florida resident.
Okay.
But I think the comment I made is I gave him $1 million. I don't think I did that, but I definitely.
Him running New York into the ground benefits Florida.
Well, yes, tangentially, but I'm looking at New York because
You're also a developer in New York.
Yeah, developer in New York. I think that anything that comes out of this that's negative is going to help kind of reestablish the city, but there's going to be a buying opportunity in New York. Maybe it's 5 years away, but I think the city has a lot. Listen, he may surprise us and do a wonderful job. I think the consensus is it's a very tough road because he's not really the right guy for the job. And I think that tangentially will benefit New York because a lot of the wealth in New York will continue to migrate down south. And that certainly is going to boost our market. I don't think, again, I may be wrong, but I don't think you're going to see this huge pop to like 10,000 people moving. But they're going to make the decision to relocate. And historically, South Florida has been the landing site for many New York City people.
Right. And you mentioned on the panel, PMG has a dozen or so projects going on right now. How are you positioning your portfolio and the next phase of growth? And then what are the three most important factors when looking at a new deal?
So we actually have about 34 projects in our pipeline that we either own sites. Everything we do is ground up, so it's usually a site. But we have about $7 or $8 billion in our pipeline to be built. And we have about $3 billion under construction. That's the 12 I talked about. Those are probably active construction projects. We want to find locations where sites that are in a strong market, where there's a growing market. Generally, what we like to do is things that are kind of urban infill or in urban locations, because you have enough people there that are where you're going to stimulate demand and you're going to have good absorption in your project. We like to establish price points. We like to look at costs. We like to know there's a margin. We talked about a 135 margin on gross costs. That's kind of our starting point. And then, lastly, we might, if it's a market that really demands a brand or a brand can be helpful, we try to marry a brand with that location. Or inversely, we like to speak to a brand and they might say, hey, we want to be in Austin, Texas. Go find me a great site. And then we'll go hunt that site down. But the math has to work. People, buildings are beautiful and architecture and the services and what we're delivering to the marketplace is great. But really, it's the math that we start with.
Yeah, everything is in the numbers.
Yes.
We're developing 2 projects in Brickell, 1 in North Bay Village. You start with the site, you look at the math, the density, the price per square foot, the costs.
Margin's got to be there because you're going to make a handful of mistakes. Even if you start at a 135 margin on cost, you say, I'm not even going to look at it if I can't do that on the back of an envelope. You have to say to yourself, I'm going to screw up half a dozen times before I get out of the ground and a dozen during construction. So that 135 might dilute down to a 120.
Right.
You don't want to dilute down to a 1-1.
And Kevin, you have 4 projects on the 11 residences. So 4 towers. You mentioned that your margin on the first one, and you sold really fast, very successful project. The margin on the first one, about 1%. The second one, 18%. The third, you said 22%. And then the fourth, a higher margin to blend around 20%.
Yeah, we're about 38 on the last one.
What's your view on larger projects? As Carlos Rosso mentioned, the timing, there's more risks.
Dude.
But Here, if you only did 2 projects, your margin would have been much lower. Are you looking for large projects that make sense for you? How do you manage timing and size of the project?
Yeah, so for us, because we're now a big company, kind of our sweet spot is 250 million and up in costs. But obviously, the larger project, there's 2 thoughts. A, it's probably as much work to build a single-family house as it is to build a 100-unit project, and all the decision. And the margin is the same margin on, a $2 million build on a house.
Exactly.
So you might as well, look at stuff. But when you get into these super talls,
Waldorf Astoria,
which is a 8-year project from the time we bought the land to the time we're going to complete. You got to be smart about your sales program. I was telling someone the other day, we probably started selling the Waldorf, sub $800 a foot, right? Which is way below the cost to build it today. So, because back then, but that's why you have to be very intelligent about, hey, when do I want to get out of the ground, and how much inventory have I sold, and how much, especially if you're in a rising market. The 11s, we're in a booming rising market, and we just got a little bedazzled by the velocity of sales.
Right.
But the downside was we're in a huge escalating cost market.
Right.
And so when you limit your ceiling of your income and costs are just squeezing you, that's why you end up with a 2% return.
Right.
And then you start to think, so today, in most cases, we'd like to try and get out of the ground somewhere between 25 and 40% in a rising market. In a flat market, then really irrelevant. In a market today, which is a little bit different, where it's a relatively flat sales market, but you have declining construction costs.
Right.
Well, that's a great place to be.
That's great. You manage your sales in-house.
We do.
And before that, did you hire brokerages? And then now that you manage your sales in-house, and the brokerage community is so important for our projects, for these developments, bringing buyers, we have to pay commissions. How has managing your sales in-house helped PMG?
So I don't, that's not really my bailiwick. Ryan Shear does more of the day-to-day management, and Veronica runs that, and we have a group, but we probably have, I'm going to guess, but I bet you we have 40 brokers in-house, and they've sold effectively about $5 billion in real estate in the last, call it 5 years. All our projects, the 11s alone were probably $1.5 billion, and Waldorf was $1.3 billion, and it's easy to get there very quickly. So it's been a real profit center for us. We used to use ISG, and Craig Studnicki, that was the owner CEO, personal friend of mine, still have dinner with him every Friday night. And we rolled him into a partnership role in a couple of projects because we took the sales away from him because we wanted to grow that business exponentially because we had a lot in our pipeline. So it's been a real success story. But managing salespeople is that's why I don't do it.
It comes with challenges.
It's challenges, yeah.
Right.
It's what do you have for me next? You always have to feed that machine, otherwise they're going to defect.
I have 2 projects in Brickell. You sold out very fast. What do you think the key to that project's success? There's no brand, the location, it's not on the water. It is a good location. What do you think the key to 120 Brickell's success was?
So we married offices with condos. That was one of the things we did there. But we bought that project with a group called Iconic, which is Zuckerberg or whatever the group.
Iconic Capital.
Yeah, Iconic Capital. And they wanted to build just about 800 rentals there. And then they realized that they wanted to be more in the lending business and didn't want to be in the building business. And in order to get that project out of we couldn't build it as a strict rental, so we had to create a much larger equity source. So we took about a third of the units. We did a condo tower, sold through it quickly, committed that as equity into the rental tower, and that's what got that project out of the ground. Building rentals today is an impossible thing to do. You can't make them pencil. No. Great when there's cheap money and there was rising rents and costs were lower. With rising costs, rising insurance, higher rates, higher cap rates, flat to moderate rising rents. you can't build a rental. I tell people, other than stick, which people are still doing, it's very tough anywhere in the U.S. to build rental. I would rather be out there buying rental where the equity's been washed, and you can buy new Class A rental at 30% below replacement cost. I'd be a buyer of that stuff. I don't know if I'd be a builder of that today. So this project only worked because the condo fed the rental.
Right. On the panel, you mentioned that the sub $1 million market is still selling, and there's been some softness, $5 million and up. Do you think that will continue into 2026?
Your guess is, listen, if I knew where that was, I'd be a much richer guy. But I think that there's still a very deep market for people that want to pay, $500,000 to $1 million for an apartment. And the high end, I think the high end, over time it'll pick up. Listen, Miami market, the problem with Miami, like versus New York, the labeling in New York is very deep, and so the peak and the trough don't fluctuate as much, and it takes a long time to get there and a shorter time to get up. Miami is still not really a really deep market, so you have really some very steep peaks and valleys. But I would tell people, as buyers, if I were in a market and I realized I wanted to buy a high-end condo, I'd want to be buying when the market's soft. So I'd advise people, hey, listen, I'm looking for a 5-bedroom, $7.5 million unit. Well, this is the opportunity to be in that market today.
Where are you spending most of your time? You're between New York and Florida.
I just flew in from New York last night.
Okay.
I was there I have a place in New York, and my wife kind of prefers New York, but I'm probably 90. I'm out west all summer. Okay. My daughter goes to school in Europe, so I'm in between London and Geneva a lot. And I'm in New York probably only about 6 weeks to 2 months a year.
Yeah.
I'm really a Florida guy for the last decade.
Okay.
I really like Florida. I'm in Aspen 2 months in the summer, and 2 months maybe in New York, and in Europe a couple of months. So maybe half a year in Florida.
That sounds great.
Yeah, and I love. Listen, I'm very fortunate. I get to go to an office with a lot smarter people than myself, and listen to what these young people have to say.
Right. And what's your outlook for 2026?
Well, I think we got to deal with our economy and the tariffs. I'm not a fan of our president. I think we're in a dangerous time. I hope that our economy at least remains stable. I hope the Democrats win the midterms next year, and I hope we dial down this lunacy about tariffs and how the economy runs.
Right.
I think we're just in a dangerous time. I think the economy was doing fine. I think the Fed would have been easing by now, and they would have eased faster. I think unemployment is just. Tariffs are now affecting unemployment. You're going to see it happening. There's a reason our sales are not stimulated, and that's causing a slowdown in the condo market. It's having a positive effect on construction, but the overall market is going to suffer a bit.
Yeah. Great. Thank you.
Okay, that's it. Great. Thank you.
That was great.
Okay.
Kevin,
Pleasure.
Thank you. Likewise.